Welcome back, everyone, for another deep dive. You ready to jump into some fresh financial news?
Always.
I mean, literally hot off the presses. Like today, January 2nd, 2025.
Wow.
We've got it all. We've got stock market analysis, economic reports from both sides of the pond, some crypto updates.
Ooh.
Bitcoin's at it again, RN. And even a peek into the world of ETFs. No, it's a lot.
It is.
But don't worry. I've got our expert here. And we are going to sift through all this noise and find the golden nuggets
That's right.
that really matter to you.
I think it's really interesting that we're getting all this news right at the start of the year.
Yeah.
This kind of sets the stage for what could be a wild ride in 2025, especially with all the uncertainties in the global economy.
Well, let's start with the buzz I keep hearing
Okay.
of this potential stock market correction in 2025. Some analysts are saying we could see a 10–15% dip after 2 years of pretty impressive gains. High valuations, potential policy shifts under the new Trump administration, and just general economic uncertainty seem to be fueling these predictions. Have you been feeling any of that market jitter yourself?
You know, markets are like giant mood rings, reflecting all sorts of anxieties.
Yeah.
But here's the important thing to remember. While a correction is possible, it's not a certainty.
Right.
These analysts are pointing to things like high valuations,
Yeah.
meaning stock prices are pretty high compared to company earnings, which could suggest things are a bit overheated.
Okay.
Then there's the whole Trump trade resurgence,
Right.
investors betting on certain sectors like utilities and energy that they think will benefit from Trump's policies. We're even seeing companies like Coca-Cola, PepsiCo, United Health, and Merck being highlighted as potentially undervalued,
Really?
which is an interesting twist.
So maybe a mixed bag on the U.S. stock market front? But what about across the pond? The UK's economic data seems to be causing some serious head-scratching. They've got gaps in their job figures, which makes it tough to know what's really going on. It's like trying to bake a cake without knowing how much flour you have.
That's a good analogy. It's a real problem because those job figures are crucial for the Bank of England to make informed decisions about interest rates. And speaking of interest rates, the London Stock Exchange had a wild 2024.
Oh, yeah.
Those high interest rates, a whopping 5.25%,
Wow.
have been great for banks, but not so much for businesses that rely on consumer spending.
Right.
Think about it. When interest rates are high, your mortgage or car loan gets more expensive, leaving you with less money to spend on other things.
It's like a financial seesaw.
Yeah.
Someone's always going up
Yeah,
while someone else is going down.
exactly.
And we see that playing out dramatically with Metro Bank soaring 156.8%, while retailers like JD Sports Fashion and B&M took a hit.
Exactly. And this highlights why diversification is so important for any investor. You don't want to put all your eggs in one basket, especially when the markets are this unpredictable.
Back in the U.S., it's the familiar story of tech giants ruling the roost. The Bannerman crew. Baidu, Alibaba, Tencent, Meta, Microsoft, Amazon, Apple, NVIDIA continue to have a massive influence on the market. But there's a fascinating development we need to talk about.
Okay.
The rise of private credit markets. This one sounds a bit intimidating. What's the deal with these private credit markets?
Well, it might sound complex, but it's actually pretty straightforward.
Okay.
Think of it this way. After the 2008 financial crisis,
Yeah.
banks got a lot stricter about lending money, especially to businesses that might be considered riskier. This created a gap, and private lenders stepped in to fill it, like private equity firms or hedge funds.
Right.
They're making loans that banks are now hesitant to make.
So why should we care about this? It seems like something happening behind closed doors, far removed from our everyday lives.
Not so fast. Private credit is actually becoming a bigger player in the economy, and that has implications for all of us. It impacts the availability of loans for businesses, which ultimately affects job creation, economic growth, and even the prices we pay for goods and services.
Wow. It's like a hidden web of connections. That influences everything.
It really is.
Okay, let's switch gears to the world of crypto. Bitcoin is on a roll, surging to over $96,500.
Wow.
Some analysts are even predicting it could hit a whopping $225,000 by the end of 2025. What's driving this incredible optimism?
Well, there are a few factors at play. First, there's the anticipation of regulatory support. Under the Trump administration, many believe he'll create a more crypto-friendly environment. Then there's the possibility of Bitcoin ETF approvals, which would make it easier for institutional investors to get in on the action.
I see.
And finally, there's just a general sense that Bitcoin is becoming more mainstream, as more people and institutions start to see it as a legitimate asset class.
It's certainly a wild ride in the crypto world. And Bitcoin isn't the only one making waves. Ethereum is also seeing some nice gains, up 3.4%. And that's partly due to the Ethereum 2.0 upgrades, which, if I remember correctly, were a pretty big deal.
Absolutely. Think of Ethereum 2.0 as a massive engine upgrade. For the Ethereum network, it was all about making it faster, more secure, and more energy efficient.
So tackling some of the big challenges holding it back.
Basically, yeah. And these upgrades seem to be paying off, making Ethereum more attractive to developers and investors alike.
And we can't forget about the other players in the crypto space. XRP and Solana are both showing strong growth, each with its own unique set of opportunities and risks.
It's important to remember that the crypto market, while exciting, is inherently volatile. Before you jump in, make sure you understand the technology, the market dynamics, and most importantly, your own risk tolerance.
Wise words.
Mhm.
All right, before we wrap up this first part of our deep dive, let's take a quick look at ETFs. They're not just your grandma's investment anymore. BlackRock, the ETF giant, is making a big push into private assets, even calling it the future of investing.
Wow, it's a sign of the times. Investors are looking for new ways to diversify their portfolios and potentially enhance returns. And ETFs, with their flexibility and ease of use, are becoming a go-to vehicle for all sorts of investment strategies.
And the numbers speak for themselves. 2024 saw a record $1.1 trillion flowing into U.S. ETFs. But it's not all smooth sailing. There's a lot of competition out there. And we're also seeing a rise in ETF closures.
That's right. Not all ETFs are created equal. Some will thrive, while others will inevitably fizzle out. It all comes down to the quality of the underlying assets, the ETF's expense ratio, its trading volume, and how well it meets a specific investor need.
Here's an interesting development.
Okay.
The first Saudi Arabia bond ETF just launched in Europe. It seems investors are looking beyond traditional markets for opportunities.
That's a good sign of globalization at work. As investors become more comfortable with emerging markets, we can expect to see even more innovative ETFs popping up, offering exposure to all corners of the world.
We've covered a lot of ground in this first part of our deep dive, but there's so much more to explore.
There is.
We've seen potential market corrections on the horizon, data headaches in the UK, the rise of private credit, Bitcoin's continued ascent, and the evolution of the ETF landscape. Whew. What stands out to you from all this?
It's fascinating to see how all these trends are interconnected. For example, the rise of private credit could actually make a market correction even more complex, especially if those loans start to go bad.
It's like a financial domino effect. One thing impacts another, and before you know it, the whole landscape is shifted.
It really has.
And speaking of shifting landscapes, let's dig a bit deeper into this Trump trade resurgence. It seems certain sectors are getting a boost based purely on what investors think will happen under the new administration.
Yeah, it's all about expectations and sentiment. Investors are anticipating a shift towards deregulation and a renewed focus on fossil fuels, which is why we're seeing increased interest in utilities and energy.
Okay.
And as we mentioned earlier, companies like Coca-Cola, PepsiCo, United Health, and Merck are being touted as potentially undervalued in this new environment.
So should we all be stocking up on Coke and Pepsi now?
Not so fast. It's important to remember that past performance doesn't guarantee future results. Investing based on political predictions is always risky. Any investment decision should be based on thorough research, not just the hype surrounding a new administration. And of course, you always want to consider your own risk tolerance and financial goals.
Right. It's about making smart, informed decisions, not just chasing the latest trend.
Exactly.
And speaking of trends, we can't ignore Tesla. They seem to be defying gravity, even with all the market uncertainty swirling around.
Well, Tesla's stock edged higher overnight. And a lot of that is tied to the Cybertruck's eligibility for tax credits and the upcoming release of their fourth quarter deliveries report. Investors are clearly excited about what Tesla is bringing to the table.
So even if we do see a market correction, some companies are still positioned to thrive. But it's not all smooth sailing for everyone. There's some serious drama unfolding. With the Murdoch media empire, it sounds like something straight out of Succession.
It does have that Shakespearean family drama feel, doesn't it? A Nevada judge just put the brakes on Rupert Murdoch's plan to consolidate control of Fox Corp and News Corp into his son Lachlan's hands. There are billions of dollars at stake. And the outcome of this power struggle could have major ripple effects across the media landscape.
It's a good reminder that financial news isn't just about numbers and charts. It's also about the people and the power dynamics that shape those numbers.
Right.
And speaking of power dynamics, let's talk about something that hits a little closer to home.
Okay.
Cybersecurity. The news about the U.S. Treasury getting hacked is Pretty unsettling.
It is. It's a stark reminder that cybersecurity is no longer just an IT issue. It's a critical concern for governments, businesses, and individuals alike. This attack on the U.S. Treasury shows that even the most sophisticated systems are vulnerable, and we need to constantly be evolving our defenses.
Feels like we're living in a digital Wild West, with hackers lurking around every corner.
Yeah.
Okay, let's switch gears and look at something a bit more tangible. The German solar sector.
Okay.
It seems they're facing some tough times, which is surprising considering the global push for renewable energy.
Yeah, the problem is that Germany's residential solar panel sector is facing a significant drop in consumer demand. This oversupply of panels has driven prices down, squeezing profit margins, and making it difficult for companies to stay afloat.
Wow.
We're even seeing bankruptcies and layoffs in the industry.
It's a reminder that even in sectors with a positive long-term outlook, there can be bumps along the road. Market forces, economic conditions, and even government policies can create challenges for businesses and investors.
Absolutely, diversification is key. And understanding the specific risks and opportunities within each sector is crucial for making informed investment decisions.
Speaking of informed decisions, let's circle back to the U.S. stock market and this potential correction. We've talked about analysts predicting a 10% to 15% dip, but there's another perspective we need to consider.
Okay.
Jim Paulson, a well-respected market strategist, has a different take on what might cause a slowdown in 2025.
Oh, really? What's he think?
Paulson is suggesting that an unexpected economic slowdown, one that's not driven by traditional factors like inflation or interest rates, could be the trigger for a correction. He points to indicators like the Citi Economic Surprise Index and movements in bond yields, which suggests that growth might be weaker than many anticipate.
So instead of inflation or interest rates being the villains, it could be something else entirely. That catches everyone off guard.
That's a bit unnerving, isn't it?
It is, and it highlights the complexity of the economy.
Yeah.
Sometimes the biggest surprises come from unexpected sources. Paulson believes that even if businesses and households are doing relatively well, a significant slowdown in GDP could spark recession fears, hit profit forecasts, and send the stock market tumbling.
It seems like we need to be prepared for anything in 2025. So let's shift gears and talk about what all this means for our listeners. We've covered a lot of ground today, from potential market corrections to the rise of private credit, from Bitcoin breaking records to the drama unfolding in media empires. It's a lot to process.
It is, and that's precisely why we do these deep dives, to help you make sense of the complex financial world and empower you to make informed decisions.
So if someone is listening to this, maybe feeling a bit overwhelmed, what's the one key takeaway they should walk away with?
I'd say having a solid financial plan is more crucial now than ever. That means setting clear goals, understanding your risk tolerance, and creating a diversified investment portfolio that aligns with your objectives.
And it sounds like staying informed is key. We can't just set our investments on autopilot and hope for the best.
Exactly. The financial landscape is constantly changing, and those who stay informed and adapt to new trends are the ones who are most likely to succeed.
So read those financial headlines, listen to podcasts like ours, and don't be afraid to seek professional advice when needed.
Absolutely. A financial advisor can help you navigate the complexities of the market and create a personalized plan that meets your specific needs.
Let's do a quick recap of what we explored today. We started with the possibility of a stock market correction fueled by factors like high valuations and political uncertainty. Then we journeyed across the pond to the UK, where economic data woes are causing headaches for policymakers.
We also delved into the fascinating world of private credit, discussing its potential impact on the economy, and explored the reasons behind Bitcoin's surge and the evolution of ETFs.
We even touched on the drama unfolding in the Murdoch media empire and the growing threat of cyber attacks. And who could forget the challenges facing Germany's solar sector?
It's been a whirlwind tour of the financial landscape, highlighting both the opportunities and the challenges that lie ahead.
Before we wrap up, I want to leave our listeners with one final thought. Of all the topics we discussed today, which one sparked your curiosity the most? What will you be keeping a close eye on as we navigate the financial waters of 2025?
Remember, knowledge is power, especially when it comes to your finances. Stay curious, stay informed, and stay engaged.
Thanks for joining us on this deep dive. Until next time, may your investments be wise and your financial future bright.